Good afternoon, ladies and gentlemen. I'm happy to see all of you here for the concluding panel of the IFX Expo International for the year 2015. My name is Aris Romas, a COO at Finance Magnates. In our last IFX Expo Asia in January, it was just 2 weeks after the SNB crisis has erupted. We also had a panel there which we switched specifically for that event, in which we discussed the crisis. But back then, everything was really fresh. And I think that from a business perspective, looking at events like the SNB crisis from a time perspective, retrospectively, and examining it is very important if one wishes to really learn from it and succeed in the next time, or see how things can be done differently in the next time such an event happens. And these events do happen. The need for knowledge in these type of events is immense. We saw earlier that in Google, the searches of the CHF were immense, and the traffic of Forex magnates back then grew ninefold within 1 day. Our traffic grew ninefold within 1 day, which means that people were really interested in learning how the industry coped with that situation. So, without further ado, I will let Viktor Golovchenko, who is the section editor of our Retail FX, introduce the panel, and then we will let our distinguished CEOs introduce themselves. Thank you very much and enjoy.
Thank you, Aris. And before the structural integrity of this building collapses into an even more traumatic event for the industry with all these CEOs here, we're starting, and thank you all for coming, and I'll let you introduce yourself first, Harpal.
Hello, can you hear me? Yeah. So my name is Harpal Sandhu. I'm the CEO of Integral. So Integral is a Silicon Valley-based technology company that runs really 2 products now. One is called FX Cloud, which is a fully hosted solution for brokers and banks to run their full FX operations. There are about 260-odd institutions now that run their systems labeled under their own names, which are operated by us as a SaaS service offering. And a second product that we've recently introduced is our back-end network to the entire market, something we call OCX, or the Open Currency Exchange, which is essentially the aggregated community of all of our institutions made available to all of our other customers for execution. So that's it.
Iskander.
I'm Skander Najjar. I'm Managing Director of ADS Securities for the Middle East. We're a company regulated under the Central Bank of the United Arab Emirates. We're headquartered in Abu Dhabi. We have a regulated entity in London as well, and Hong Kong. Our capitalization is $400 million. We're established in 2010. We're predominantly a brokerage arm, but we have our own technology as well. We've developed our own platform, which is a multi-asset solution. We really are quite strong, and we're heavily targeting the retail markets as well as the brokerage institutional markets altogether.
Yes, my name is Mark Berkey. I'm the CEO of Swissquote Bank. So Swissquote Bank, we are a bank regulated in Switzerland, and we have offices in London, Dubai, Hong Kong. So we are mainly in the online trading business, and with a very strong focus on FX.
My name is Andrew Ralich. I am the CEO and co-founder of 10 Financial Systems. We are a connectivity provider for the retail and institutional FX space. Started in this space about 6 years ago, primarily providing enterprise quality bridging and connectivity solutions for the MetaTrader platform. And over the course of the past 6 years have developed a network of clients, platforms, back-end and reporting connectivity that has now made up what we call our hub solution, which we see as a universal adapter and central point of management for the retailer or institutional FX participant to manage liquidity relationships, front-end platforms, and engage with their clients in a unified fashion.
François Lamberni, Head of Sales at London Capital Group in London. We are a London-based broker listed on the LSE, and we offer 3,000 instruments to retail customers, mainly FX and CFDs, but also stocks and commodities, etc.
All right, so we all know what happened 5 months ago, but in order to do a short recap, also this retrospectively looking, it's we all know that it's very easy to criticize what happened, but could you tell us right now, 5 months later, what was the biggest surprise in the aftermath of the SNB event that didn't even occur to you that was going to happen?
Well, I think there were two phases of surprise. Well, maybe you say three phases. First one, it's a significant event in terms of market price movement. The observation was that the technology infrastructure actually held up remarkably well. So there weren't really significant technology systems operations issues that came out of it. Second observation was that I think people didn't really understand their risks, and it's probably been talked about now for months, but the obvious one that what people thought was market risk issues actually turned out to be credit risk issues and all that observation. I think the most interesting surprise now after all this time is that people were surprised by the movement and immediately believed afterwards that now that this has happened once, it can happen again. Therefore, I'm going to change all of my assessments about risk now that it's happened. But in fact, I mean, our view is that people that got it wrong the first time tend to continue to get it wrong repeatedly. And probably one of the things that people are getting wrong is that now that this has happened, you can fully expect it to happen again immediately. And having lived in California now for 27 odd years, I can tell you immediately after the earthquake, everybody believes an earthquake is going to happen again tomorrow. It actually doesn't happen for some time.
Right.
But we all buy earthquake insurance, within the 12 months after the earthquake, and it's the absolute best time for insurance companies because their premiums go way up and the payouts aren't going to happen for a while.
Right. So same thing is happening in the industry right now, I guess.
For me, it's more really a vote of confidence that came out post the event, in the sense that there was a lot of talk about what will happen to the industry. How far can we withstand such a huge hit into the market? But from a business point of view, it was really from within 3 hours, it was really trying to onboard as much business as possible, trying to maintain the client's support and client interest as best as we can. We weren't hit as badly as many of our partners in the industry, but it was really business as usual from day one. And it gives you a vote of confidence to give you of how strong this market has grown into over the last decade and where it's going over the next coming quarters or coming decades. Really, you don't see these events, as Harpal mentioned, quite often, but when they did come, it withstood it and it carried on in a strong manner.
All right. So, Mark, you're a fellow Switzerland citizen.
Yes.
What did surprise you?
Well, when it's typically what we could call a black swan event. Now, when you look back, it looks like kind of obvious that this would have happened because it was in the air, and there are a lot of discussions when it will happen, actually. So what was not anticipated is the two things that at the same time that you had this incredible liquidity squeeze that actually was absolutely not anticipated. So even though I remember discussions we had, say, okay, they may give it up, but you will have volumes actually continuing to safeguard the systems for a while. And what's happening basically is that for an hour you couldn't hardly find a counterparty to make a decent price. So this was my biggest surprise. And there are two things that actually makes this industry work, or two beliefs, let's say. The first one is that the liquidity is infinite. When I first started into FX, this is what everyone is telling you. Say, you can give leverage because every single second you can actually close a position of a client. So this happened to be wrong in this specific case. And then the second belief that was wrong as well was that the tick by tick increase or decrease could not be higher than 1%. Actually, in this case, it was 30%. So combining this with the liquidity squeeze actually provoked this disaster. What surprised me the most, and what I think is unacceptable for the industry in which we are, is that clients actually could not get their deposits. You know, it's okay if you're an investor that you lose money, but if you just have money with whether it's a bank or a broker, and actually because the broker goes bankrupt, that you cannot access your money, this is unacceptable, and this is where we need to have an opinion, and probably also to find solutions, because ask the clients from Alpari how happy they are that still months after this happens, they cannot gain access to the money, and we don't know yet how much the haircut will be. So this is very bad for the industry.
Right. Andrew?
I think there were two major things that I would say were surprises in the immediate aftermath for me as the result of the event. And one of them is a negative or a challenge that I see in the industry, and one of them is actually a positive or a demonstration of, I think, a lot of the opportunity that still exists in this space. So on the negative side, I think it was really surprising to a lot of people how long it took the immediate dust to settle. From a micro perspective, a lot of the smaller retail brokers that 1-0 engages with, moments, hours, and to some extent days after the event, weren't able to immediately quantify, I see what happened to the market, but what happened to me? What's my risk? Where am I actually out? Did I make money, lose money? Am I in debit to my clients? What position of Swiss was I carrying into this? And at a macro level, the banks themselves, the liquidity providers, kind of the roots of what feeds the execution throughout the industry, actually also took days at times to actually choose what price they were going to settle positions at. I think from a technology perspective, our latency clock on last look was going into the hours and days on some of these prices, and I think that's a challenge the industry has to look at. Sorry. The opportunity I see and the surprise I think coming out of it is from a retail-facing perspective, you had two major players in the market, Alpari and FXCM, in absolute trauma. And the result of that on the remainder of the industry was a ripple, and it certainly affected all of us, but I think you can look at so many other markets, and if you were to chop off two of the major players, the residual effects would be so much stronger and resonate so much more. And depending on how you're looking at it, the fragmentation of this industry, the disparate nature, the B-book risk pools versus consolidated risk pools that exist out there, though correctly not infinite, we're able to be resilient enough to kind of just go in stride the next day and continue to operate. And I think approaching that fragmentation and seeing it as a positive, and if I was a broker that was not a top 5 broker, I'd look and say, wow, I could be them, and even disappearing in a moment doesn't make that disruptive impact on the industry as a whole. And I think that says a lot about what's been built and how we've approached that fragmented pooling of risk and clearing of risk as the industry's evolved.
All right. Francois?
Well, I think a lot has been said. In terms of surprises, I mean, I'm not very surprised that we have yet another crisis. I mean, we went through the Lehman collapse, we went the AIG collapse, and a lot of different crises, and it's going to happen again. As Alpa said, maybe not tomorrow, but again, I think what this event has crystallized is really the emphasis that you need to have on risk management. And we've been sold for years that the agency model is a safe model, and this is not true. You have a credit and market risk, and this business needs to have market professionals that know how to handle those crises. And so you need people that look at your risk as a firm and manage this properly. And a lot of places we're not doing that properly. And the leaders of the industry that everybody assumed were doing a good job are actually doing a very poor job in risk management. Yeah. And so the emphasis here is, one, repricing of credit from the prime brokers and from everybody, and the price going up there, and who's going to be having access to the market in the end. And I guess as a second step, the effect on liquidity. Is pricing going to go wider because not everybody is going to have access to liquidity? And the second aspect is that you need to have proper risk management. And the idea that by having only credit risk, your safe is firm is a false assumption.
False concept.
What it is, you need to have a good mix of risk on your book, and you need to have credit risk and market risk. And I think after years of people spitting on the B-book model, I say, it's the revenge of all the market makers today. So I think now clients will look at firms and say, well, how are you managing your risk? Are you fully credit risk, or are you, exposed to market in some aspects? And I will ask the good questions, which are how are you managing your risk? That's it.
Yeah, I think Alpari had a B-book model as well, no?
I've been tipping a lot of it, yeah.
Well, with the B-book model, it very much depends on which side you are, because at the end of the day, the positions are taken by the clients. So, I mean, it's a lucky pick. You may be on the right side or not. I mean, that's the problem. There is no miracle actually. When something's like a 30% drop happens, what can you do?
The point is that you don't have to run after your customers if they go bust. If they owe you money, that's the point. Yeah.
All right, so speaking of risk management, from what I have seen on the books of major brokers, the market exposure in the Euro Swiss was dramatically one-sided to between 90 and 99% of people shorting the Swiss franc. So why hasn't this been identified as a major risk by these brokers? Why do you think that has been overlooked?
I mean, it's difficult to speak on behalf of other brokers, but many brokers did take that into consideration. We increased our margin on that pair. We really made it as unattractive as possible for clients to take those positions because the indicators looked and took that into consideration. But I think what's been mentioned on the panel, people are looking at much more of an advanced risk management model, taking options, taking futures into account, to protect their positions in some capacity. And we had taken an option on the Euro Swiss at the time, which protected us to some measures. We had increased our margin, which protected us. But nonetheless, I think the way you manage your pool, the analysis that you're doing on your book, is ever changing. And I think this was a big lesson for everyone. Those who survived and those who got hurt, the same. I think across any industry you'd find similar, situations where it's for the benefit of the industry as a whole, which in turn is going to be for the benefit of the client as a whole. Yeah. I think that's where we are today.
Well, it was very simple. It's because the Swiss National Bank had high credibility. I mean, that's the point. When Mr. Hildebrand said, whatever happens, we keep it at 120. It will not increase further. Then actually he had an absolute credibility, and Hildebrand was a very strong man. He had a very high opinion about actually this minimum of 120. What actually nobody really realized is that when this happens, Mr. Hildebrand was not in charge anymore. He has been dismissed out of probably political reasons in Switzerland, and his successor, Mr. Jordan, actually, even though he would say this is also my policy, in the beginning, he inherited this situation from his predecessor, and he was less a supporter actually of that, and that's why when Europe decided for the quantitative easing before this happening, he decided to give up basically. And the reason why everyone actually was so one-sided is simply because these ongoing messages for weeks and months were saying whatever is happening, we keep this 120. Everyone believed they have some kind of a Swiss National Bank put to protect them, and because since the price was at 120, say okay, it can only go in one direction. What nobody realized is actually the Hildebrand put has been replaced by the Jordan put, and this one was less solid than the first one.
Right. Okay.
I think if your question is why was everybody, well, there's two questions. Why was everybody one-sided? And the second is why didn't people manage their risk? So, history is full of examples where investors or speculators love picking up pennies in front of a steamroller. You just assume the steamroller is moving so slowly, and if it's free money and I can keep picking it up, it's fine. But the moment something happens, and it leads to a bad result, then people are surprised. But the same thing happened in every business that financial institutions have been involved in that involves leverage. Right, so you look at the financial crisis and what happened with the derivatives and the leverage that took place there. I mean, the only difference between investment banks in 2007 and 1997 was the tripling of leverage that they took on in their balance sheets post the regulatory reform that took place in Christmas Eve of 1999. So this really all just comes down to a risk management issue, and I think it's really important that people recognize that the risks that institutions face are independent, whether they be an operations/technology risk or systems risk, a market risk, or a credit risk. And so if the question is, why did they take on certain market risk? That's their business model, right? So whether somebody is, quote unquote, an A Booker or STP shop or holds on to inventory, that's a risk policy decision. And I think what was surprising about this was people thought that the primary risk decision they were taking was about market risk. Right. But actually, they were in the business of extending loans. That's what leverage is all about. They were extending loans, and they allowed their customers to overextend themselves in a volatile market, carried the risk of that customer, and then were left holding the bag, not unlike a foreclosed house in the financial crisis. So they took credit risk, and that was the problem.
If I can just, I think it's been summarized perfectly just to extend Harpal's analogy of the steamroller and to combine it with the abruptness and the surprise of this, I think was the big thing. And I actually think we have learned now that you can pick up pennies in front of a steamroller if you assume that a steamroller can only drive 2 miles an hour. And what happened is somebody snuck a Tesla motor into a steamroller, and all of a sudden it accelerated 0 to 60 in 3 seconds. And it's not maybe necessarily that brokers didn't know that they had that risk or that position on, but they assumed, like when the ECB or the Fed in the US are going to make a quantitative easing or an interest change, Janet Yellen coughs at lunch, and if she coughed twice, that means it's going to be 3 months, and things start to price in, and that was always the assumption of any move that big could happen, but it would price in. And I think we've now learned that that steamroller can actually accelerate a lot faster than we think, and we have to prepare ourselves for that.
Yeah, high frequency trading firms also learned it. All right, so Francois, you have anything?
I just wanted to summarize. I think Harpal did the perfect summary. There's no free lunch, and I think people thought there was one, and there's never a free lunch in the markets, so that's it.
All right. So let's make a duel here. Not a duel, but Andrew and Harpal, since you're on the technology side, just want to see your perspective on the vulnerabilities that struck you the most amongst the structure of...
Still talking about the Swiss franc issue.
Yeah, yeah.
So first of all, I'd say from the technology perspective, they actually didn't expose vulnerabilities all that significant. I mean, this was a massive market move, and there was quite a lot of trading going on during this particular time. But generally speaking, the stresses placed on the systems on that particular day weren't particularly different than any larger NFP event or a Draghi speech or a Yellen unannounced message that would have come out. So I don't think there was any particular issue there. The only thing that I think was unique amongst technology firms who provide platforms was this whole notion of circuit breakers and whether there was any uniformity or policy associated with whether the price discovery that was being given out to customers, whether those customers be brokers or the brokers' customers themselves, end users, whether the price discovery was actually valid. Right. Because prices were being displayed in the market that weren't necessarily going to be fulfilled if they were a last look basis. And prices were coming out of order books that were just nonsense. And in fact, it was validated by the fact that after the fact, a few days afterwards, some of the order books had to reprice those. So there were certain platforms, Integral included, that had built-in circuit breakers. So Integral, CME, a number of the other platforms that sort of think through boundary conditions of what may happen and separate out the value proposition of price discovery from execution that actually suspended price discovery for a period of time because it was clear that the prices that were being displayed were not actually executable. And had people attempted to do it, it either would have led to a result that would have had to be unwound, which is bad, but even worse was it could have been attempted upon and had no result whatsoever. And one would have had the ambiguity of not knowing whether their position was covered or not. And that was actually the worst case that was taking place in the market. People who had attempted to enter into positions and didn't actually know where they stood. And that was incredibly ugly. So unlike what Andrew was talking about in terms of a lot of his clients not knowing what was going on, I think virtually 100% of Integral's clients globally knew what was going on to the extent that they continued to use Integral systems. And in fact, in the few cases where they didn't, it was because they weren't using Integral system during that period of time. And in fact, we got calls on this saying, hey, what are you doing? Turn off your pricing, fix this, fix that. And we're like, you know what? We're not actually even on right now because the pricing isn't accurate. So the problems you are having are because you are trading in an environment where the price discovery you are seeing is not valid. So I think the idea that people don't actually appreciate, how OTC markets work, and that technology isn't simply just, effectively managing systems isn't just about the plumbing, isn't just about the technology. It's actually appreciating the network that is running, the content that's running over it, and the context that it should be used. And we were fortunate that things worked extremely smoothly. We had zero issues other than educating people as to what had taken place, and it was quite good.
All right. Andrew?
I'm going to disappoint you slightly and actually agree with Harpal a lot on what he said. I think one of the
that your customers had problems?
We'll get to your customers in a second, or maybe in the next few years. I think the technology in the industry, and I think this is a ubiquitous opinion, is that technology held up extremely well through this. Bandwidth-wise, looking at resource-wise, it was like a surprising non-farm number, and maybe not much more. The request for functionality and features with 2020 retroactive hindsight was really where technology providers were challenged, I think, as a result of this. And that's the kill switch or filtering or whatever you want to call it, the ability for a piece of technology to intelligently say, okay, the SNB just pulled the peg. It's probably going to go to 85, but 35 isn't valid, so I need to turn that quote off. Or I need to turn my entire system off because I have no idea where it's going. And we often talk to our clients, and it just depends on what happened to you yesterday. If yesterday you got burnt by an off-market quote, you want to filter everything that's even seemingly off the norm. If yesterday your system filtered the first 30 quotes of a nasty non-farm move because it looked like it was off market, well, you want to make sure that every quote gets through as fast as it possibly can because your clients need to be able to trade on them. And so, the same system that turned off and protected a lot of clients from SMB is the same one that we'll often see from platforms with that type of management. Shut off a symbol during non-farm. And I think the brokers and the people looking for this type of functionality, you need to balance those two things. Do you want to hit the first quote on a flash crash that has a legitimate 5% move? Sure, but that's going to be done at the expense of killing and protecting you from an off-market quote or whichever LP is either going rogue and had a technology failure or is the first guy to the party of a major move. We're working a lot with clients to try to balance those things, but there isn't a scientific algorithmic function that can be implemented in your system that says it's artificial intelligence and I can tell you if an off-market quote is good or bad.
Right.
So,
you
I just want to follow up on a point that was raised earlier because I think it is really important now that some time has elapsed. You know, the observation that was made earlier that FXCM was one of the victims of this event, and that you know, their demise wasn't really felt in the market. I want to clarify something. FXCM actually didn't exit the market, and it was business as usual throughout the entire event. That is one of the reasons why there was no effect seen. And Alpari's UK operation in isolation actually wasn't that significant of a player. FXCM is a very significant player. Nothing happened with the exception of FXCM's common equity value getting wiped out. Their balance sheet was recapitalized within 36 hours of the event, and customers' deposits were completely protected. Their vendors, whom they owed money to, primarily their prime broker, was paid off within 24 hours. Their regulatory capital was there, and it came at the expense of their common equity. So, you know, I feel badly for the common equity holders and the management team and other people that owned shares in the company. But as far as the customers were concerned, as far as the liquidity, as far as the infrastructure, everything else, it continues to perform just you know, normally. So there was no actual disruption to the market in spite of their loss. What I actually think is happening, and it may not be recognized for some time, is the effect of the movement or the event that took place is actually still happening now.
Yes.
And it is a slow motion train wreck that is taking place. And it is happening on an incremental basis. And you will see it manifested in lots of subtle ways, but I'll call out a couple of anecdotal pieces of evidence. A broker being told by a service provider that they will be turned off in 90 days. Please make arrangements. A service provider who provides credit as a product being told that the price of that service has now increased by 2x or 3x, effective 30 days or 45 days from now, and if it's too high for you, by all means, please find another service provider and we'll help manage the transition. All of those deadlines are starting to take place over the course of this summer and in the next few quarters. So you will actually start to see the impact of an event that happened in Q1 of 2015 really start to manifest itself in a restructuring of the market and a repricing of the market and various services that are provided in the market, starting with credit, moving to technology, moving to lots of other services, where they will go up significantly over the course of the next year. And the reason is, post the event, people have repriced how valuable those services were.
Right.
And the service providers themselves have recognized that we actually provide, in some cases, the infrastructure to this, and we don't get paid nearly enough for it. And in fact, where people thought there were such obvious alternatives to it, those alternatives don't exist because those alternatives collapsed under the crisis. So what happened was the water went out. The people who actually weren't wearing bathing suits were exposed. Those that were, the ones left standing, have actually realized, you know what, we were being forced to compete with people who actually didn't have anything to offer. And once the crisis happened, and once the impact of the crisis is being felt, that's being made clear, and those that have sort of survived and have shown the strength of their infrastructure, whatever it was, are actually rising up. So this is going to keep taking place. It'll probably be, I'd say, 4 to 6 quarters before it's fully appreciated.
All right. Mark, you wanted to add something?
Well, reality is that you need equity. Okay, I mean, FXCM, it went probably beyond their equity, so the losses they had. So the clients of FXCM were extremely lucky that Jefferies actually came and, you know, put 300 million on the table to
Lucadia, Jefferies' parent.
So look, what happened to us? I mean, the total negative balances of all the clients was 25 million. Okay, that we had to cover almost instantly because we are a bank, and as a bank, you know, you have to make sure that your books are always okay. Everything we do needs to be covered by proper equity, and why isn't that a problem? Because as a bank you have this equity. You can support those kind of things. In this case specific, actually, we have excess cash of 100 million, so we could actually pay out the 25 million without any problem. But even though we would have had no equity, no excess cash, the Basel III plus FINMA equity actually is protecting the clients from exactly those type of situations. My quest, I think, what this industry should learn, or what the regulator should learn, is that let's say, the weaker regulated brokers in this market should actually get the equity hike. You know, equity is what is protecting the clients from such situations. And if you look at even the UK, which is a great regulator, but probably the equity base that was needed for letting Alpari making his type of business was not sufficient. I mean, the proof is that they went bankrupt, and now probably there will be a haircut of, let's say, 20% for what the clients has deposited with Alpari. So we need equity, we need higher regulations, we need serious partners that can support this kind of event, because it will happen again, you know, and you should be prepared. The only way of being prepared is to be strong enough actually to support those kind of things. So when I say 25 million, it was not actually Swissquote that lost 25 million. It's our clients. And of course we may recover part of that 25 million. Maybe not. We don't know yet. But the provision we took covers the risk, and then continue business as usual.
All right. Well, it's easy for you to say that we need more regulation. You're in one of the most regulated, if not the most regulated countries. Yeah. So, what do you think, Iskander, on this? You're also under a very tough regulator.
Yeah, I mean, we're regulated on a number of different jurisdictions, and I think it's key, and I think it's a natural progression for the industry to move into a more regulated territory. And I think the advantage of that, yes, margins will get squeezed, but at the same time, it's going to add more confidence to the market. So the client base is going to get far larger, and you're no longer going to be dealing with it's no longer going to be a smaller asset class within a portfolio, but with the added confidence, it's going to take larger chunks of those investment portfolios. So, look, the best interest of the client is to work with a much more structured regulatory body that can take these black swan events into considerations, but you're never going to be able to tick all those boxes. But I think capitalization is key. You know, I think that's shown that those who could withstand it and manage those situations within 24 hours as opposed to weeks and months proved themselves in that situation. Yeah. And I think what clients are looking for today is very, very different to what they were looking for in the SNB. I mean, capitalization is much more important. Regulation is still important. I mean, look, FCA was one of the highest regulators out there, but it still suffered a traumatic situation. Yeah. So we're still in the discovery phase, and I think Harpal's point is very, very true on that. Is the strategies that were put in place over Q1 and Q2 are being executed in Q3 and Q4. Now, the repercussions of those strategies will be made clear, and we might have put the wrong strategies down. Maybe we have to adjust those once again, and we'll discover that in 2016.
All right.
Actually, I disagree here. I mean, we can all agree that we need better technology and we need more capitalization. But name me in history where regulation and capitalization prevented crisis. I mean, Lehman Brothers was a pretty stable bank. AIG was a pretty good custodian, and they went bust in a couple of hours as well. I mean, so what you need is market professionals. What you need is people that know risk and that manage risk properly. Everybody thinks that because you have good technology, you can have kids managing risk. The result is no. You need market professionals that know market, that assess the risk properly. We're in the markets. You need market professionals. You can have layers and layers of circuit breakers and technology. This will all go to hell when the market moves quickly. And regulations, but yeah, maybe you can have more capital, but if XCM lost 300 million in half an hour, I mean, how much capital do you need? So you need to do an FX brokerage with $1 billion now? Is that what it is? And how many billions are you going to be selling sure that you're not going to go bust? So yes, more capital is good. Yes, more technology is good, but a bunch of brokers asking for more regulation, in my opinion, is wrong. I mean, we need to ask for less regulation, and we need to ask for us to make more money, not to be buried in compliance and paperwork just to make some guy happy who doesn't know the market works. Finally, on the FCA, I want to say the FCA, one thing, is Alpari clients are going to get most of their money, not 30%. I mean, I'm very involved with some customers trying to transfer money to Alpari to LCG, so I can tell you, they're going to get 95% of their money. So the FCA is working fine, and the FCA is regulated an awful amount of brokers. It's not like Switzerland where there's two guys that are doing this business. In the UK, there's a proper industry with like dozens of brokers, so thank you very much. One of them went bust, but yeah, okay. We're still doing okay.
I think there's a zero-sum game here that's difficult because brokers being able to make more money while also having to take a significant haircut on their margins, and that does trickle to liquidity providers, technology providers as well, it is going to be what we see over the next 6 to 8 months. Either spreads are going to get wider, like Harpal said, clearing costs are doubling, the need to have capital available to you, both to cover situations like a debit, but also to meet these higher bars that the Tier 1 and other prime brokers are setting now in order to participate with the clearing relationship. So in one hand, we're saying we need a lot more money, and on the other hand, we're saying we need to make more money at the same time on a thinner margined environment. So it's going to be difficult.
All right.
Let's see.
Well,
Hey.
let's see, Mark.
I mean, equity is what is protecting the clients at the end of the day. So it's true that in Switzerland, actually, the regulator decided that when you want to do FX business, you need to be a bank, which is probably some kind of an overkill because it's, you don't need to be regulated strictly under Basel III to provide this service, and I'm okay with that. But there's still a huge gap between what we have to provide as an equity and what, let's say, a easier regulation requests as an equity. It's probably a way in the middle where that would be fine.
No, exactly.
I think equity really, and everyone has to understand this, equity is protecting the client at the end of the day. I'm not sure that it will be 99%. My fear is that the haircut will be much higher because, I mean, days after this happens, we have been involved into, everyone starting to panicking, say, you can buy a Alpari for almost nothing, but you have to pay for the haircut. And the haircut was substantial. Now they started to sell the Alpari websites. They try to sell whatever they can. They do a fantastic job. But at the end of the day, there will be a haircut. And this is not good. It's not good for the industry, and it's not good for it's not good for our industry, basically. So normally, when you put money, whether it's a broker or a bank or whatever, the clients must have the 100% security that he can withdraw the money, whatever is happening in the market, unless he's trading and losing the money. It's a different case.
I think Mark, we're in agreement. I don't want to get out of this that we disagree. I agree more capital is good. I agree more regulation is good. You need to watch where you're putting your money, but you also need market professionals. I think that's the point we're forgetting here. That's all.
Harpal has the floor.
I kind of agree with a piece of everything you're saying, but it is kind of interesting that the two really well-capitalized brokers are asking for everyone else to have lots of capital. But isn't it at the end of the day just simple math? You are giving leverage to clients, and it's the leverage ratio that will dictate everything. So whether you have $100 million or $100 billion, if at the end of the day you're making loans that are in excess of the implied or expected volatility of the underlying asset that those loans, are tracking or derivatives of, then it doesn't matter how much equity you have. If the underlying asset moves by 20 or 30%, it will get wiped out.
It's true. It's true. But however, when you are a bank, actually,
so it's two things: equity and decreased leverage.
Yeah. Well, it's linked because when you are a bank, actually, the amount of leverage you can give to the clients collectively depends on your equity. So this is a limiting factor. Now, the leverage itself, probably this industry will have to be more reasonable. We give leverage up to 500. The question is that reasonable? No, it's not. If you say, the tick by tick variation of any currency pair cannot be higher than 1%, then you should give a leverage of 100. Now, in this specific case with the SNB, even a leverage of 100 would not have saved the clients. You would have
20 wouldn't have saved.
No, 30%, then you can give a leverage of 3, actually.
Right.
So then you're out of business. Now, the question is, what should we do? Because we don't want this to happen again for our clients. Okay, so we have to think about, should we still give leverage to currencies that are so highly manipulated? My answer is no. No, certainly not. The Swiss francs now, it's gone. It's behind us. So it's probably the currency pair is floating again. But what about the Danish kronen? Who is giving leverage to the Danish kronen? Nobody.
So it still comes back to a risk management policy on the part of the broker or the bank.
Sure, but since this is still a wild industry, we should have. there should be some sense of self-regulation. You know, there should be some kind of a code of conduct to say, let's not pushing this too far. Let's stay at something like.
So can I ask you guys a broad question? Because I agree with what you're saying, but Francois' point is exactly on target. And let me just ask you the question in this way: even if you increase the regulation in certain markets, won't the customer and won't brokers just arbitrage the markets to move to a better regulatory environment? I don't know if you guys read the news today, but Plus 500 is re-signing up their customers now under Cyprus jurisdiction because the UK was too tight in terms of their KYC requirements. So they just moved and they just shot. I mean, why are we sitting here in Cyprus? It's a beautiful island, by the way. And other than the storm that we're experiencing, it has great weather and so on. But we're here because they have looser regulations, and brokers from Israel and various other countries moved here. So you could tighten up regulations all you want. If the customers want high leverage and they want a free option to be able to take giant positions, and if it goes their way, they keep the money, and if it doesn't go their way, they can walk away, brokers will offer it, and brokers will register themselves wherever they can.
I agree with what you say. However, why are there international rules like Basel III? That actually it's exactly because of that. Because globally, when you are a bank, you cannot just do whatever you want because you have a jurisdiction that is supporting your. So there are some kind of minimum rules. I don't like regulation actually. You know, it's horrible to be regulated as a bank. It's very time consuming and you have to interact with a lot of people. The only positive part of regulation is based on equity. It's actually just that, you know, they would request a minimum equity, and whatever you do, you need to be properly financed. Now that the clients or the brokers will go to the place that are lesser regulated, this is a natural move. This is why I say this industry. I mean, unless we want something really to happen, that somewhere someone will say, okay, look at this, guys. This is just banking business. All those brokers needs to become a bank worldwide, and then it would have a major impact on our industry. We don't want this. This is why I say we need to have some sense of self-regulation. You know, we should, which the industry actually, or the big actors or the big brokers in this industry should say, okay, there are certain let's say common sense rules that we should not cross.
And self-regulation sounds a lot like market professionalism.
Stop stealing my role, Harpo.
To take a point of each broker becoming a bank, which I think brings us to a subject that Francois brought up originally, and we haven't really touched on yet, is maybe not the B-book revolution, but the resurgence of internalizing risk as a risk management, not a risk creator, but a risk management facility to better use capital and to allow you to operate your brokerage, operate your business in a way where you're not as reliant on the upstream leverage or credit that you're being provided, and take it internally. And I'd like to, without putting anybody on the spot, I'd like to hear from the brokers here. 10 is not an entity that takes risks or manages risks, but we are very fearful of haircuts, by the way. That's a scary thing for our whole brand image, but that's a different thing.
All right.
Are your brokers looking to internalize more, or is that?
Iskander wanted to say something.
Oh, sorry.
Yeah.
Well, from my side, it's just we're in a situation, or the discussion's stuck on, is it risk management or is it equity? Well, I think it's a combination of everything, and I think it's an evolutionary process that we're going through within the industry. I don't think it's one versus the other, but I think we need to tick all those boxes. You know, I think we have to have much more complex risk management solutions. As Andrew is saying, yes, people are looking at their books in an entirely different way. They're looking at how they can manage it, how they can protect themselves in different ways. There's not one. It's not. Let's say an A book versus a B book versus a C book policy that people are looking at. And from equity, yeah, without a doubt. I mean, Alpari did suffer because of its low capitalization. FXCM had access to liquidity because it had a strong book really to support it, which allowed it to access liquidity to some extent. And if we want to protect the clients to some extent, then if we have that equity as, let's say, a first protective measure, then if Alpari was capitalized enough, then there wouldn't be a discussion here about Alpari. And
No.
it was one of the top 5 in the industry.
I agree, but as Opal said, you can be very well capitalized, have a lot of money, but if you're doing a lot of loans, if you're taking a lot of risk, you can bust everything in a couple of minutes.
As a protective measure, not as the sole measure.
No, I
As
understand.
one
I
of-
understand. But my point is, of course, we need better technology, better regulation. We need market professionals. But I think what's very important is really to know your clients from the broker side, to know who they're dealing with and the type of trading that they're doing, and from the customers, know your broker. And I think it boils down to transparency. And really, people should deal with listed companies, ideally on the LSE or something like that. But this is really what the customer should look at: the financials of the brokers they're dealing with, and checking the risk that those people are taking. And so the bottom line is, in my opinion, more technology, more regulation, market professionals, and transparency. And so I just wanted to put
Everything
LSE
is on the
listed, that's all.
table. All right, makes it difficult. So, Mark, you wanted to add something before?
No, well, the question was about what can we do, or how should we approach the solution actually to avoid any similar situation in the future.
Yeah.
I mean, there are 2 things we can do. The first one is not giving any more leverage on not manipulated currency, because every currency is manipulated in a certain way. But let's say don't give any more leverage to currencies that are kept artificially at a certain level. Because when it's releasing, then the drop may be significant. So probably be cautious on Hong Kong dollar right now, because it's in a bandwidth with the US dollar, even though the Chinese central bank may be stronger than the Swiss one. Not giving any leverage on Danish krone. So those kind of measures, please be really cautious there. And then probably every bank or every broker needs to have risk scenarios. Actually, the way we're doing it is we take all the currencies where we have positions in, and we extract scenarios. What would happen from -10 to +10% tick by tick? Where would we go? And we did set our internal limit to 10 million. Say, okay, we can. Why 10 million is because still it would be okay from an equity standpoint. So we added actually voluntarily our 10 million to the Basel III plus Swiss Finnish buffer that is imposed to us, and say, okay, let's put 10 million additionally, and let's do not consider this 10 million as excess cash. But no, this is this kind of approach, and it goes to what you say. I mean, you need to have a risk approach to your book, whether it's internalized or whether it's hedged outside, and then based on scenarios, see where you are. And it's probably the learning curve for every participant in the market is that you have to do your homework, you have to go through the books, and then if you're outside of your risk limit, then start to call the client, say, hey guys, sorry, we are too high, you should reduce, this event may happen, or those kind of interaction. We did it with I have one example, we did it recently with the Turkish lira. It was shortly before a potential rate change, and we started to call the clients, say, hey, you're exposing yourself and ourselves to too high risk. Unless you start to reduce, we may change the leverage. Actually, it's working well, because clients are aware now. They knew what happens to the Swiss franc, so they react very positively to that, and it's a welcome speech. Actually, say, okay, someone is looking at looking to see what could go wrong.
Clients are getting educated. So Francois has the last word before we give it to the audience.
No, I say I've seen in a lot of risk committee, and typically I was taking naps, and now we don't actually read the documents that they give us, and so you have a very good document that we have to do for FCA regulation, which is called the ICAP, which you look at all the stress scenarios according to what happened to the firm if X, Y, and Z. And so yes, as Mark said, this is what you got to do on a regular basis, and so I think I highlighted the importance of risk management really. So this is my conclusion.
All right. Well, the audience has the floor now. Okay, let's accommodate the first row.
Hello? Yeah. I was listening to what you said, Francois, about the FCA. It's not actually true to say that only one company went bankrupt in the UK. A week or two after the event, another company called BT Prime, who were here last year and had a stand, went under. And the FCA didn't even know about it until the ex-owner reported BT Prime to the regulator, and they were then shut down the next morning. Now with that, and obviously with Alpari as well, went many small companies that their clients, unregulated companies and operating out of places like the Seychelles, which BT Prime helped people to set up in. And we're talking about maybe, I don't know, in the hundreds in terms of companies that went under, who aren't anymore here. And every single one of their clients got nothing back because these companies put all their liquidity and all their money through companies like BT Prime. And my question to the panel today is, who is overseeing the regulator? Who is overseeing the FCA? Why did the FCA allow this company, capitalized at £125,000, to take millions and millions and millions of dollars in deposits immediately after it was regulated, and then more and more and more, with its track history under Boston Technology of being badly run, and everybody knows that, and then to allow the same group of people to then take on client funds, and a small earthquake or an earthquake in the industry came down, and there probably are tens of thousands of people today out of pocket because of the FCA allowing this company to be regulated. And my question amongst us all today is, who is overseeing the regulators and who's sitting up there? Because we can all say what we're going to do, but ultimately it's the regulator's job. And why are they not here being open about it? Because we never hear from them, we never see them, because they're like gods in the industry. Somebody needs to be overlooking what the regulators do.
Good point. I don't follow Bankruptcy Weekly, but the FCA has a lot of brokers. I mean, BT Prime in the UK was a closet and 4 people in it. So, I mean, yes, the FCA was not going in there every day. But the point is, I think, yes, we can ask the police to check that everything goes well, but in the end, it's the responsibility, I think, of the industry and of the market participants to try to know who their brokers are and know who their clients are. This is my point. I agree with you. The FCA should have done more, and maybe the Bank of England is going to tap on his shoulder and say do a little more. But the UK is a pretty big broker business, as you know. It's a very, very big part of the industry, and so should the authorities in the UK say, okay, to do this business now you need to be a bank? I personally don't think it's required. So should we take an approach like the Swiss? I don't know. I think I strongly believe in free markets and not too much regulation. Now you need to find the right balance. I guess the FCA made a mistake there. I guess you're right. But so that's an interesting subject anyway. But I would rather say let's make sure that we have a fair playing field and that we can actually give a good service to the client. The problem with too much regulation is that he ends up being priced for the client. So the client is going to have to trade and pay more. So you need to find the right balance between the customer not paying too much and then stopping trading because they have no chance to really make money if they pay a ton of commissions. And on the other end, making sure that their money is safe. So again, I think the right balance is the answer. Yeah.
All right, Mark.
Never ask a regulated entity to say something about the regulator. So we were regulated in the UK as well, and FCA does a fantastic job. Just for the record, if we no, look. It's a regulator actually has 2 missions. The first one, it has to monitor the industry, but also it has to make an attractive place for investors and for companies. So it's a trade-off between keeping the place safe and keeping the place attractive. The reason why probably Switzerland went complete extreme is because but Switzerland as such is not the prime place where you would go for FX. Well, it happens we happen to be in Switzerland and having a bank license before we actually entered into FX. But there are specialized jurisdictions that specializes on FX, and I mean it's an industry, it's a business for them, so they try to keep it attractive. This is the only answer. But I'm 100% sure that the FCA, they maybe a little bit slow, but they will do something, and I wouldn't be surprised that that simply would ask for more equity in the future.
All right, more questions?
Hi, I want to ask Harpal and the CEO of 10 of the being tech companies in today's evolving times. Where do you see the roadmap and the future of tech companies like you all, and what are your plans for the future, and how would you evolve?
I think listening to Mark's list of requirements and analysis that his brokerage is going through in terms of how they want to better be able to per currency manage things like margin, That's a brokerage challenge because you need to decide which currencies to margin more or less. But that's also actually a technology challenge. There are cloud-hosted, ubiquitous FX infrastructure platforms out there today that, when setting up a pre-trade risk account, will only allow you to set one margin limit. And the reason for that is because it's a technology challenge. Analyzing different margin levels in real time through all of these quotes and events and things that are going on puts a lot of pressure on technology. So I think from our standpoint, we're listening to the needs of our clients, what they're going to be doing from a risk standpoint, and looking at ways that we can optimize, enhance, and develop our technology to facilitate that and still deliver in a way that has the same real-time reliability and performance. So, you know, margin risk, you basically named our laundry list of development priorities. Pre-trade risk for margin individual symbols, and more advanced analytics, knowing what's my credit risk, teaching retail brokers what VAR is, and building more advanced analytic platforms than just, here's my manager terminal and my position risk is this and clients lost money today so my broker's working. There's more that needs to be unearthed there, and brokers need to deliver to us as technology providers what their compliance or risk needs are, and we need to find ways to optimize and build our technologies to do so. And
All right.
Humbly speaking, I think that there's a lot of, this industry's reaching a maturation cycle in terms of technology. 8 to 10 years to maintain a code base makes it difficult to do some of these things. So I think you will see some of the legacy providers start to stumble to be able to change their system this way, and there will be opportunities for firms that have developed a younger, more extensible code base to address these challenges more quickly and thus protect our clients more.
All right, Harpal, you have the last
So
word.
we're driven, our plans are totally driven by the needs of our partners and our customers. We live in interesting times now. So the requirements and the challenges in our partners, have been shifting very quickly. So their ability to work with their service providers, namely credit, their ability to access liquidity in the market, their ability to provide higher availability systems to their customers, and for their ability to basically grow their businesses with lower costs and lower risk. Drives everything we do. So every aspect of their business are things that we're working on, we've probably rolled out more products in the last 18 months than we've done in the last 6 or 7 years. It'll keep going at that pace. So I actually don't think that we're anywhere close to a maturity point in technology in this industry. If anything, we are becoming much, much more automated. Because people want to reduce operational risk. I think we're becoming much more statistically driven because they want to reduce market risk. And I think we're being much more thoughtful about the relationships that people have and how to optimize those relationships related to capital allocation to access credit and things like that. So optimization is everything.
All right, well, do we have, last one.
Thank you very much. Валерий Барташевич, ADS Securities in Abu Dhabi. I have question both to respected technology providers present on the panel and to brokers. Would you like to comment on the way counterparties define off-market prices and on the effects of historical repricings? Just generally, what you see as a good market practice, what people shall do about this? What's the fair way to handle all these difficult situations?
So I'll just give a short piece of observation about that. So we believe there should be more effective benchmarking in the market. About a year and a half ago, we finished a project between Integral and Stanford to capture the data of the market. So we have well over 8,000 streams that come into our system today. And we have, the PhD students in the School of Business at Stanford devised a methodology to arrive at a benchmark for where the industry is and to eliminate the ability for market participants to game that index. We track that index across all major currency pairs on a second-by-second basis and publish it for free out in the market. So that's published every single day at the end of trading, at the end of the New York business day at 5 o'clock, and it's posted to a website at fxbenchmark.com. That benchmark will become real-time very soon, and it's freely made available to the market. And we believe things like that and transparency like that will really increase people's comfort level and confidence in terms of where the market's actually at, and move away from sort of the bilateral negotiation that happens after the fact of whether a particular trade was on or off market.
Well, I think before technology there was a problem like that as well. You can just look at the Bank of England rules, and you need to know without the big brokers for a specific currency where the most volume, and did they trade there or not. And then if you're on par with this, then it's a negotiation with your counterparty. I mean, there's no no need for massive amount of technology. If you do your dollar, you check where EBS was, and then you know roughly that the market is going to be there. If you're close, then you're going to eat up the point or 2 points that the other guy gets, and you're going to get into negotiation. If it's very far from where the market is, then it's unfair, and you say, okay, well, you got to put me back at a regular price. It's it's an OTC market, it's a negotiation, but check whether business is done usually, what the most volume is, and you see what the price is there. I mean, this is you don't need it's better if you have benchmarking and all those fancy tools, but you can just call brokers and they should know. So.
I think it's an interesting dichotomy because for me personally, one of the things that makes this industry so exciting, so technically challenging, and so novel is the fragmented nature of the industry. So the simplest technology answer is we all decide on one platform, we build a global exchange, and we just route everything through there, so there's centralized price discovery and a benchmark that's established in one platform. But I think the reason that a lot of us are here, that this industry still generates so much excitement, investment, and mental energy and capital is that there's so much opportunity presented by the fact that pricing is so disparate, that there's the ability to have all these different pools. And so I think that's a challenge that will be an interesting thing to see evolve. I think prior to SNB, many people would say, okay, I want to compare my rate to EBS. And that's okay. It may be older technology, but it's a good staple. And I believe there was no price on EBS for about 15 minutes following SNB.
Right.
So it seems like a conglomerate 8,000 broker aggregate feed of pricing still has this sensitivity of the fact that each pool is independent and these regulatory districts are independent, and that there is the ability and kind of the uniqueness in this industry to have it spread so far apart, and that's what makes it so opportunistic and exciting. So I think we need to find a balance of the two in order to keep the novel nature of the space while also protecting ourselves at the same time.
All right. Okay. Well, Mark, Iskander, you have concluding words, or everything has been said already? We'll never expand this subject.
Okay, good. So thank you very much, Victor. And I hope the audience enjoyed this learned discussion just as much as I did. This concludes the IFX Expo International for the year 2015. I hope you enjoyed it.